At its peak, Terra wasn't just one of the largest projects in crypto, it was one of its most confident, a $60 billion ecosystem powering payments, savings, lending, and an algorithmic stablecoin that claimed it had solved one of modern finance's hardest problems: how to create digital money that stays stable without relying on trust in institutions. Then almost overnight, it collapsed. In less than a week, Terra went from being described as foundational infrastructure for the future of finance to a case study in catastrophic failure. Tens of billions of dollars evaporated. A top 10 cryptocurrency became nearly worthless. Millions of users watched what they believed was stable fall apart in real time. But Terra still matters. Not because it failed, but because of how it failed. This wasn't a meme coin implosion or a reckless experiment run on the fringes of the market. Terra was backed by some of the most respected venture capital firms in crypto. It was integrated into real products. It was discussed in serious policy conversations. For many investors, Terra wasn't the risky part of their portfolio, it was the conservative one. That's what made the collapse so shocking. Terra wasn't built on obvious fraud or technical bugs. It didn't break because of a single hack or rogue actor. It broke because its design relied on something far more fragile than code: collective belief. The belief that incentives would always work, that markets would always self-correct, that confidence once earned could be assumed. For months, years even, that belief seemed justified. The system held, the peg stayed intact, volatility was absorbed, growth accelerated. Terra appeared to turn one of crypto's biggest weaknesses, instability, into its greatest strength. It didn't resist stress, it redirected it. And because it worked, people stopped asking what would happen if it didn't. When Terra finally began to crack, the response wasn't slow or orderly, it was violent. Prices didn't drift, they collapsed. Confidence didn't weaken, it vanished. And once it did, the mechanisms designed to protect the system began to actively destroy it. What followed wasn't just a failure of a project, but a moment of reckoning for the entire crypto industry. Algorithmic stablecoins were no longer theoretical. Systemic risk was no longer abstract. Terra forced the market to confront a reality it preferred to ignore. Some systems are optimized for growth, not survival. So Terra's story isn't just about crypto, it's about incentives that work until they don't. About stability that exists only in calm conditions. And about how quickly a system can unravel when confidence turns against it. Because the real mystery isn't why Terra collapsed so fast. The real mystery is why so many believed it couldn't. Section 2. What Terra was trying to build. To understand Terra's collapse, you first have to understand its ambition, because Terra wasn't trying to tweak the financial system or improve it at the edges. It was attempting something far more radical. Terra wanted to remove the need for trust in banks, governments, and reserves altogether, and replace them with a self-regulating economic machine. In Terra's vision, stability wouldn't come from authority or collateral, but from behavior. Rational actors responding to incentives, enforcing balance without human intervention. It wasn't just a product, it was a theory about how markets should behave, encoded into money itself. At the center of this vision was an idea many in crypto considered the holy grail: an algorithmic stablecoin, a digital currency designed to remain close to $1, not because it was backed by real dollars sitting in a bank account, but because its structure would force the market to keep it there. No reserves, no custodians. Just incentives, arbitrage, and the assumption that confidence could be engineered and sustained through design alone. That stablecoin was called Terra USD, or UST. UST had a partner token, LUNA, and the relationship between them was the entire system. The rule was simple. One UST was always meant to be worth $1. If UST traded above $1, the system allowed users to create new UST by destroying or burning $1 worth of Luna. If UST traded below $1, users could burn UST and receive $1 worth of Luna instead. In theory, this created balance. When UST was too expensive, supply increased. When it was too cheap, supply decreased. Traders chasing profit would do the stabilizing automatically. No central authority, no reserves, just incentives. Luna absorbed the volatility so UST didn't have to. This design was considered revolutionary because it promised scalability. Traditional stablecoins were limited by the amount of collateral they held. Terra claimed it could grow endlessly, powered by demand and market logic rather than locked capital. And demand did grow, fast. Terra wasn't just a currency, it was an ecosystem built around payments, savings, and decentralized applications. In some countries, Terra-powered payment apps were used for everyday transactions. Within crypto, UST became a preferred stablecoin for trading, lending, and yield farming. As UST demand increased, more Luna was burned. As Luna supply shrank, its price rose. And as Luna's price rose, confidence in the system deepened. It felt self-reinforcing, elegant, almost inevitable. But hidden inside this elegance was an assumption so critical that few questioned it, that markets would always behave rationally, and that confidence would never disappear all at once. Because Terra didn't just require belief to function, it required continuous belief, and that dependency would soon be tested. Section 3, Anchor Protocol and Artificial Demand. If Terra was the engine, Anchor Protocol was the fuel that made it explode in size. Anchor wasn't marketed as speculation, it was marketed as safety. Its promise was simple and powerful. Deposit your Terra USD and earn nearly 20% annual yield, consistently, predictably, and with minimal risk. In a world where banks offered almost nothing and crypto yields fluctuated wildly, Anchor felt unreal. Not just generous, but rational. The messaging was careful. This wasn't gambling. This was decentralized savings, and people believed it. Capital flooded in, not because users needed UST for payments or applications, but because Anchor paid them to hold it. Terra USD stopped being a currency and became a yield vehicle. The majority of UST in existence wasn't circulating. It was parked, waiting, earning. This distinction mattered more than it seemed. Anchor's yield didn't come from organic economic activity. It wasn't generated by borrowers paying high interest or businesses creating real value at scale. It was subsidized, propped up by reserves, incentives, and the expectation that growth itself would eventually justify the returns. As long as new money kept entering the system, the illusion held. More deposits meant more UST demand. More UST demand meant more Luna burned. More Luna burned meant higher prices. Higher prices reinforced confidence, and confidence attracted even more capital. It looked like adoption. It felt like stability, but it was dependency. Anchor didn't just accelerate Terra's growth. It concentrated its risk. The entire ecosystem began to orbit one incentive: yield. When returns became the primary reason people stayed, loyalty wasn't real, it was rented. There were early warning signs. The reserves backing Anchor's yields were draining faster than expected. Discussions emerged about sustainability. Quiet adjustments were made behind the scenes. But as long as the numbers stayed attractive, few wanted to look too closely. Because questioning Anchor meant questioning Terra itself. And that was the real danger. When confidence is built on incentives rather than necessity, it doesn't fade gradually. It flips. The moment the yield looks uncertain, the same capital that rushed in becomes desperate to leave. Anchor created growth, but it also created a single point of failure. A system designed to feel like a savings account was, in reality, a pressure chamber. It worked perfectly, as long as no one tried to exit all at once. If this video helped you see Bitcoin's history more clearly, like this video. It really helps the channel. Subscribe for more deep, simple documentaries on money, technology, and the stories that shape the digital world.